Thank you so much, Aditya. Thanks for giving us the opportunity to showcase ourselves. Um, I do hope that by next year, when you introduce me, being a woman in finance is not a USP anymore as the community grows and we have many more women. But thanks, I am so super excited about this topic, this subject, because, I think personally, especially in the last 2 years, if we see the way the investments, I'll go straight into my presentation. And if we look at how much of money has left India's borders to go abroad, I'm sure everyone's gut feel is that the numbers have increased. But if you look at the graph, the numbers have actually gone up four times since 2017. So where the monthly average was about $500 million a month, we've actually been touching 2 billion per month. And the reasons are fairly obvious. I think COVID has taught us a lot of things: currency depreciation, political uncertainty. You name it. There are enough reasons why Indian residents have been wanting to move monies offshore. Let's look at what's permitted before we dive into what we can offer. Let's look at what the RBI permits you. And actually, the RBI introduced what's called the LRS, as most of you on the call will be aware, but no harm, just talking about it again. The liberalized remittance system in 2004, but it's really, gathered steam and picked up size in the last few years. Every resident Indian is allowed to remit up to 250,000 US dollars per person per annum per fiscal year. These monies are allowed to be, used for both current and capital account transactions or a combination thereof. So actually, if you look at the breakup on the RBI website, it's very little, and it's, less than 6% of this, which actually goes into debt and equity offshore. And we're hoping this small base is only, leads to higher and higher growth from this. Where we see a lot of money going is into, educating children abroad, tourism, donations, maintenance of family members, medical expenses, etc. So this really does form a large chunk. The permissible capital account transactions are really opening bank accounts abroad, purchase of property, making investments abroad, as long as they're non-leveraged. So listed and unlisted equity, debt instruments, funds, promissory notes, REITs, etc. So there are many, many products which are permissible under capital account transactions. A lot of this money, again, that has left India's borders has gone towards the US. So if you look at the geographical breakup, obviously the FANG stocks, the tech sectors have been the market's darlings over the last 2 years. Yes, there was good performance for some time. Some have taken a beating. So where do we as Singapore group, the SGX group, how can we play a role? Who we are, etc., is what I would like to just spend the next, 5 or 10 minutes about. So as Aditya mentioned, as prudent risk advisors, what do? We always diversify our risk by not putting all our eggs into the same basket. So depending on your risk appetite, depending on your age, depending on, how much disposable income, each of us has, we look at, out of our basket of 100% of investable surpluses, how much are you willing to, risk the principal on, and how much are you not? And obviously those ratios change as our risk appetite changes, as we grow from, our 20s to our 50s to our, retirement stage of life. So where I look at SGX and Singapore investments is really that maybe 15 to 20% low risk category, your safety investments in your diversified basket of investments. Why Singapore? Singapore is, at the end of the day, an international business and wealth center. More than half of the world's population is really within proximity of Singapore. So if you look at China, India, and Southeast Asia, that really is more than half of the world's population. Singapore holds 85 avoidance of double taxation agreements. The 23 jurisdictions are covered by the free trade agreement. I mean, there are reasons why Singapore is one of the 2 or 3 largest private banking, centers today. As per Fitch rating, Singapore continues to be a AAA rated country. Given the political uncertainty and the way we've seen countries in the last couple of years, I think it's very important when you invest your funds, you need to be sure that where the country that you're putting your money in, the bank you're putting your money in, is credit worthy. Singapore has rated #1 in Asia for intellectual property protection, #2 in the world for the ease of doing business. So these are some of our laurels. Singapore is also actually the most international exchange, and this may not come as a very obvious kind of an adjective to describe SGX, but if you look at the breakup, more than 43% of our market cap is actually non-Singaporean. Now, this is very important because it represents a basket of Southeast Asian. So out of the 43%, which is not Singapore, we have a lot of Aussie, Australian, Malaysian, Philippine, China. So we have a lot of diversification from a little less than half of our market cap actually being contributed by non-Singapore companies. If you just look at a glance of whether it's the Australian Stock Exchange, Hong Kong, London, NASDAQ, NYSE, the numbers are fairly small. It's only LSE, which has 28% non-UK, but NASDAQ is less than 5%. Hong Kong is less than 1% non-Chinese. So the advantage of an internationalized stock exchange is, of course, very high. We're also a multi-asset exchange group headquartered in AAA rated Singapore. We are an international multi-asset exchange focused on expanding the strength of our platform and services for our clients. We are operating in more than 15 international cities, including our group companies. We are highly diversified with a global distribution network, high operating and EBITDA margins. Most importantly, we are systematically important financial infrastructure. Now, why is it important that we are a multi-asset exchange? It's important because you have one platform where you could perhaps deal equities, fixed income, currencies, and going forth with our acquisition of many, many other different companies in the last 2 or 3 years, we will be a single platform being able to offer you almost all equity classes. Let's just look at once again what our customers and our partners recognize the value that we bring to the table. If I look at the latest, then in 2021-22, SGX has been awarded the Derivative Exchange of the Year 2021 by the Asia Risk Awards. Also, the Asia Pacific's Derivative Exchange of the Year 21 by Global Capital. We also got the Commodity Exchange of the Year by Energy Risk Asia, the Best Specialist ESG Index Provider. As most of you may also be aware, last week, July 29th, we, along with our collaboration with the National Stock Exchange, have launched Nifty futures in Gift City. That has been an extremely big and important step showing our commitment towards India and Indian indices. So we are only expanding in all directions, in all asset classes. We will continue to expand our platform and our market reach to answer our customer demands. As I said, SGX NSE IFSC Connect has gone live last week. We are expanding our mutual offset system with the CME. We are listing SGX New Zealand dairy derivatives. We have tie-ups with Thailand, Singapore Depository Receipt. We have very, very recently also have a tie-up in the NASDAQ/NYSE for dual listing of equity. So, I mean, you talk about it and we're there, whether it's equities, currencies, commodities, various indices, even when it comes to ESG, carbon impact indices, new thematics, ESG. So we're all there. So this is a broad overview of what Singapore is about, what the SGX could offer in India, what the RBI permits resident Indians to do. And I will now hand over the baton to Jeff, who's our strategist based out of Singapore, and he'll take you into a little more detail about the sort of risk return analysis, what can you expect out of Singapore, and we look forward to lots of queries one-on-one. Reach out to us via Aditya, and we'd be more than happy to take you through more details. Thanks once again for this opportunity.